Welcome to Barron's Roundtable, where we get behind the headlines and prepare you for the week ahead. I'm Andy Serwer, in for Jack Otter. Coming up, Meredith Whitney famously called the 2008 financial crisis. She joins us on what she's seeing now and what's ahead for the market. Plus, a look at some attractive dividend stocks and how they could reward shareholders for years to come. But we begin with our expert panel and three things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Jack Howe, Teresa Rivas, and Andrew Berry. Guys, it was the first week of trading after the summer holiday. Not much to chew on until we got to Friday when we had not such a great jobs report. Jack, what's your take?
It stunk. It stunk. Employers added 22,000 jobs in August. That's well below the estimate. It turns out now that they shed jobs in July. It was the first decline since the first year of the COVID pandemic. So the good news is that the weak job market makes a quarter-point rate cut basically a slam dunk. You can't even say that a half-point cut is out of the question. It's not likely, but the betting odds there on Friday were about 14% for a half-point cut. Falling rates make stocks and bonds more attractive. Right? That's good, right? But the problem is you'd much rather have the Fed leaning toward cutting rates because inflation is muted and we're not quite there yet. So that's why I think that the stock market didn't really charge higher on Friday. It did end slightly higher for the week.
You know, you saw a reset of Fed cut expectations on Friday. The markets are now expecting 3 quarter-point reductions this year. It had been 2. And they think that the short rates could be 3% or less by the end of 2026, compared with around 4.5% now.
Yeah. We're left now with a stock market it's 24 times this year's projected earnings. To me, that's expensive, right? Deutsche Bank, if you look at past periods when it's been that expensive, the subsequent 10-year returns tended to disappoint. Deutsche Bank says that's a possibility now. Evercore ISI says no way. They say we're headed 20% higher from here by the end of next year. Their case rests on what I'll call artificial intelligence nirvana, right? That's what that's
rose-colored glasses too.
Right. It says that AI is going to be bigger than the internet. So if you believe that case, you stay loaded up on your S&P 500 fund. If you're not convinced, you just make sure you're diversified. You can still get good deals on overseas stocks. They've done twice as well as the U.S. market this year. Dividend stocks look cheap too.
What should we be looking for next week, Jack?
We get inflation on Friday. I would love to see that rate fall. B of A says they expect it to rise. They think it might hit its highest point in a year. Not much on tap for earnings, but we'll see Oracle, Kroger, and Adobe.
All right, he just mentioned inflation. Andrew, the ultimate inflation hedge, gold, has been hot to trot lately.
Well, I mean, gold's been rocking this year, and you saw a rally this year that has accelerated in the last couple weeks or so. Gold topped $3,500 an ounce this past week and finished at a record high of nearly $3,600 an ounce on Friday. A couple factors have been driving that. You've had fiscal deficits worldwide, central bank buying, and you've had a weaker dollar. Gold is the anti-dollar. Also, you have lower rates, and that helps gold too. And this rally in gold could have legs. I mean, U.S. investors, I think, are very much underinvested in gold right now. I think a lot of financial advisors are embarrassed to recommend gold. I think many investors think it's an investment for kooks, cranks, and survivalists. But if that changes, I mean, gold could really move. Goldman Sachs came out with a report this week saying gold could be headed to $5,000 an ounce.
All right, I'm not going to ask him if he's got any gold coins squirreled away. But what about any other precious metals, Andrew?
Well, you know, silver's also been moving. It's up about a similar amount to gold, top $40 an ounce. One place to look is platinum, where you basically it's trading around $1,400 an ounce, a big discount to gold. If you're looking to play precious metals, you have the GLD ETF, which is for the gold itself, GDX, which is an ETF for the gold mining stocks like Newmont and Barron, which are 2 leading gold mining companies.
Teresa, there was one stock, at least one stock, that was glittery this week. What about it?
That's right. So Google parent Alphabet hit a new high because they basically walked away from their U.S. antitrust case with a slap on the wrist. Now, I'm not going to say all their problems are over. We can talk about some remaining issues, but this was a huge overhang for the stock. They weren't forced to break up or do any divestitures, so it worked out really well. I can understand why the market was pleased.
And this is actually good news for Apple as well, kind of their partner situation going on there, right?
Exactly. So as part of the ruling, Google's going to be able to continue to pay Apple above $20 billion a year, maybe $25 billion is the number now, to be the default search engine on their products. So that's great news. That basically all just goes right to Apple's bottom line. It's the best kind of revenue you can ask for. And speaking of Apple, next week they get to make the news themselves because they're going to be having their signature fall event where they introduce the new iPhone. I know that expectations aren't really high, but that also makes them easy to beat. So I think it'll be interesting to watch there.
Anyone in the market for a new iPhone at this point?
No, I'm not setting up the lawn chair at the front of the line like we're doing.
That's old school. I mean, it's not as big an event as it used to be, but, it's still a big deal for this company.
Exactly.
And plus, they get the $25 billion back in their pocket, so good stuff there. All right, new jobs data painting a troubling picture as hiring slowed way more than expected and unemployment climbed.